Most traders are attracted to day trading because of the speed at which you can make returns. But does that mean that day trading is more profitable than swing trading? We're going to find out today. All right, let's roll the intro. New to the channel? What's up? My name is Cleveland and I worked as a professional trader and analyst for 6 years. And now I'm here to bring you my daily insights on business, capital markets, finance, and more. Enjoy the video and welcome to the channel. All right, traders, let's get right into it. How do we rationalize and figure out if day trading is more profitable than swing trading or vice versa? Well, first, what we need to do is we need to understand the inherent mechanics of a day trading system and the inherent mechanics of a swing trading system. And we got to come to some type of conclusion that we can all agree on, right? So let's talk about day trading first. We all should be able to try to rationalize the fact that day trading is when you get in and out of a trade within a 24-hour period, right? And there are certain components of day trading that are really important. If you're day trading, then technical analysis is going to be very important because you need to be able to identify intra-market trading opportunities on smaller time frames, right? Some day traders some people are high frequency traders, right? Where they're taking hundreds of thousands of trades a day. And some people are trading on maybe the 30-minute and the 1 hour where they're in and out of markets and maybe can grab 6 to 8 different trading opportunities on any given day, right? Now, I'm not arguing the legitimacy of being able to create a profitable day trading system versus a profitable swing trading system. I feel like I should say right now off the cuff, I am a swing trader and I believe that new traders coming into Forex, stocks, whatever, I believe that swing trading is the more profitable way to go simply just based off of the structural dynamics of the business. And we'll talk about that in just a second. But in general, when you're taking a day trade, the trading opportunity you're trying to capitalize on can't be that big. A lot of traders try to find these insane risk to reward ratios in markets, but in a day trading system, you're trading in a smaller time frame, and being in a smaller time frame means your price action is just going to surmount to less point movement, right? I mean, you're only going to go up so far until you hit that target, and those targets are usually intraday targets. Now, day traders basically think they compensate for this by having more trading opportunities than swing traders, and this is why day traders think that you can get more money or make more money day trading rather than swing trading. Right? But there's another issue there, right? Because when it comes to day trading, there's one key element that swing trading has over day trading, and that's a risk management technique that isn't very popular in the retail trading world, but is extremely popular in the professional, institutional, and bank trading business. And that's the Kelly criterion. Okay, so what is the Kelly criterion? Well, the Kelly criterion states, if you are in a heightened time of probability, you risk more capital. We need to break that down though. What does that mean if you're in a heightened times of probability? If you feel like probabilistically an outcome is going to be dramatically skewed in your favor, you risk more capital. Now, it's harder to get to that point in a day trading opportunity because remember, with day trades, you're going to be executing so many trades. They're going to all be based off of a similar strategy. Right? Most traders, retail traders who are day traders, talk about their entry strategy where they look for a certain confluence or a certain indicator and they execute that specific indication of, hey, get in the market now over and over and over again. Swing trading is a little bit different though. You have less trades, but you have more certainty with those positions getting into profit. And there's one simple reason why: fundamental analysis. Fundamentals. Understanding why the market is moving, right, gives you an edge. That edge allows you to discern whether or not you want to take a trade based on the fundamental sentiment at hand or not, rather than simply just the technicals. For example, everyone talks about the George Soros trade, right? That's one of the more popular Forex trades in the history. Well, he obviously didn't simply rely on a technical entry point and a technical strategy. He had fundamental data that the British pound was going to be massively more valued than the euro and would eventually depeg, right? So that fundamental data came from economics, okay? And so what did he do? He didn't break the Bank of England with a 1% to 3% trade on that particular trading opportunity. That's what the more technical day trader guy does. They can usually only risk 1% to 3%. It's baked into their methodology. Most retail traders say, yeah, risk 1% to 3% per trade. Fundamental traders and swing traders don't trade in that same capacity though, because when a trading opportunity comes along, you get a chance to weigh capital on that trading opportunity based on the data. And that's something that you can't do in a day trading system. Another example of this is Michael Burry with The Big Short, right? When he saw that the US housing market was basically nothing more than a combination of a bunch of defaulted loans that appeared to be AAA rated, he realized that the housing market and the general price of the stock market was oversold. So then he put a lot of capital on that trading opportunity. That was the Kelly criterion at play, right? Where basically he said, hey, there is a high probability that all of these people are going to go into default. Since that's the case, we're not going to take a normal trade as if we would on a day-to-day. We now have certainty and data to back a trading decision that would amount to more risk on that particular position. What this does for a portfolio is allows the portfolio to get excess returns and generate alpha, right? And alpha, if you guys don't understand, is the excess returns generated in a trading system that's better than the market, right? So let's say the S&P 500 went up 10% and your firm went up 12%, your alpha is 2%. Right? So the data allows you to weigh more capital and generate that alpha and get more size on individual positions. This is why swing trading is so amazing because one, right, you get data as to why the trades are actually even taking place and why the market is moving, right? We took a swing trade a few weeks ago on the euro, basically saying that the euro was going to sell because of all the madness that was happening in Ukraine and Russia. And what happened, right? It doesn't take rocket science that if Russia invades Ukraine, we're going to get a collapse of the currency. Russia invaded Ukraine February 24th, but they were talking about it and it was in news headlines since February 11th. Once February 24th came around and Russia actually ended up sending all these thousands of troops into Ukraine, then the market started to collapse. And you actually had days and days and days to get in on that trade. Markets, the Euro USD, for example, went from 114 all the way down to 108, right? That's over a 600 pip move. And with compounding strategies, with triple, quadruple, and 5 entries, I mean, you can really take that sell side move all the way to that low or even halfway, and you've made hundreds of pips in that particular trading opportunity. And because we trade fundamentals, we knew exactly why we were getting on the trade. It wasn't just technical structures, right? And that gave us more certainty, basically saying, hey, it's likely this is going to happen. So we were also able to weigh more capital. And a lot of our traders inside of our little Discord, they ended up doing quite well there. So I want to say here, I'm not saying that you should not day trade. I kind of think it should be more of a bell curve. Take a look at this little picture here that I drew up. I think this bell curve represents very well how much you should day trade, how much you should be swing trading, and how often, if you're a trader, should be looking at long-term trading positions, almost slash investing. I think really somewhere around 60% of most trading systems should incorporate swing trading from basically saying, hey, between 1 day and 4 weeks, those are really where the best trades are, because that Euro USD position where the Euro sold off, it took weeks for that trade to go from 1400 to 1800. And if I'm in and out of markets, more than likely I'm going to miss a lot of that. Rather than day trades, there are some amazing day trading opportunities that trigger and that you could easily liquidate at the end of the trading day, right? But they don't come as often. Same with long-term swing trading, right? Long-term swing trading is oftentimes, again, a profitable trading strategy. But if you're trying to make a little bit more of a frequency in terms of a turnaround, then I think swing trading in general is a sweet spot. All right. So I want to know you guys' thoughts on this. The data does show that most successful traders, all the successful traders in history that you've ever heard about, Paul Tudor Jones, George Soros, whether you like him or, hate him, Michael Burry, the silver-haired devil who just took 23 million and turned it into about $1 billion during COVID, shorting the market. That trade, he was in and out. We made a video on that way back in the day. He was in and out on that position in about 2 weeks, 23 to $1 billion in less than 2 weeks. Okay. So again, this is why I believe documentation shows that swing trading and the best traders in the world are swing trading. They oftentimes get in on day trading positions, but they don't come as often. And when they're holding long positions, they, again, are probably more of a long-term outlook style firm anyway, right? But from the retail guy in his home, I think swing trading is perfect. Now, this is my opinion. I hope you guys realize that I'm not smashing on day trading here. I just think that from a methodical point of view, swing trading is the best bet. Let me know in your comments down below. I hope that we can have a civil discourse about this. I know traders can get very antsy, intense. when I talk about day trading, or you need to start trading with $10,000 instead of $50 or whatever. Okay. But let's be civil. If you guys have any questions, let me know. We do fundamental research inside of our Top Trader University, where we are coming every day with the latest fundamental trends that are going to be driving markets, giving you guys a directional edge in your trading every day. It's the best research portal on the internet. All right. If you guys want more access to that, the link is in the bio. I hope you guys trade safe. All right. We'll be cranking out some more videos this week. Peace out.